Hey, everybody, it is Wednesday, so we are coming to you live from Investing Education Academy. Today, we're going to be talking about the rising interest rates and what it will do, what they'll do to your actual stock portfolio. So, as always, this is that time. Please share it, contact a friend. We have been getting some great engagement. You all have been amazing with sharing the content. And also, you've been great with just sending feedback about, what you wanted to hear and reaching out to us to speak to some family groups, fraternities, sororities. Doing tomorrow, or actually Friday, Leon and I will be doing a keynote presentation, a keynote speech for Constance, and we're excited about that. It's the Keep It Real conference series. So this is going to be our first or second keynote together. And long story short, is getting the information out. And our biggest goal, our mission, the mission of IAA, is to demystify the stock market and other investments so our members can profit. And every time we get opportunity to take the stage somewhere, it gives us another chance to reach a community that we normally don't talk to do what? Demystify the stock market. So if you are listening through the podcast, thank you. It is continuing to grow. We are getting listeners in Belgium, Greece. There were some in Liberia, a large number actually in Canada. China actually was crazy, but long story short, the reach is expanding. It's because of you all. It's because of the support. Please continue to subscribe to the podcast. That helps us out, and also it lets us make you aware of when new articles are coming out or new podcasts are coming out. So with that being said, again, today we're talking about how the rising interest rates will affect your stock portfolio. And while Leon tells you why we chose that topic, I will also remind everybody, if you would like, we will be going to Clubhouse after this is over. And if you want to join us, you look for Leon Noble or look for Brent Simpson. We're going to take the conversation over there, and we're going to have some fun with that. Just anything can happen over there, so that's kind of cool. Leon, you can go ahead and tell them why we chose the topic, and I'll do some housekeeping.
Yeah, so this topic is, it's about interest rates, right? So it's typically kind of boring. But Brent and I rag on interest rates all the time, how they're low, how you get nothing out of savings account. You should get your money should not, investment dollars should not be sitting in anything that's interest bearing. All that is true, right? All that is factual and true. However, today we're going to be talking about bond interest rates, not necessarily savings account interest rates. And the reason we're doing that is, so a lot of people that are, following, that are part of IEA or follow the podcast, know that the stock market has been erratic as hell the last 2 weeks. Today, the market was down almost 1.5%. It's really been struggling, just kind of grinding, kind of up and down each day, really a lot of volatility. And the reason for that primarily is bond interest rates. And going to explain kind of why that is. So just a quick background on bonds. And again, boring subject, but it's actually really important. So bonds right now, so we know right now in savings accounts, the average interest rate in the savings account is 0.05%, which is effectively zero. The 10-year bond, when you say bonds, I'm going to be referencing the 10-year bond, because that's the one that's really tracked by most of Wall Street. It affects mortgage rates, so it's really important. So the 10-year rate, the 10-year interest rate the interest rate on the 10-year bond just 2 days ago touched 1.6%. Now, that sounds like nothing, right? Because we all know the stock market generally returns 10% per year on average. But that's actually really, really huge, because a year ago, the 10-year bond was yielding 0.50%, so half of 1%. 1 year ago, in July of last year, was yielding 0.5%. So between then and today, the bond interest rate has risen 177%. Now, the reason why all this is important is because, so hedge funds with big money, they're in the market, as we know. They're the ones that actually move the market. However, the market is risky, right? And bond rates have been at effectively zero since COVID hit in March. So the reason the market has been going, we went from 35% drop in March to making new highs within a month, the fastest drop and the fastest recovery in the history of the market. Part of the reason why is because all these big hedge funds, pension funds, they moved their money out of bonds because the Fed took the bond rate to effectively zero. So they're like, crap, we got to put our money someplace to get yield. Where they dumped it in the stock market, and the stock market went crazy and shot up. So from March of last year to about earlier this year, December, January, bonds were relatively low, right? They were under 1%. They recently touched 1%. And like I said, 2 days ago, they touched 1.6%. Again, reason why this is big, think about it. If you have $10 billion to be, not our money, not retail investor money, but tens of billions of dollars, you're cool with getting 1.5, 1.6% on your money, because that turns out to be hundreds of millions, if not billions of dollars over 10 years. So these big hedge funds, they're like, well, wait, 6 months ago, 8 months ago, I was getting 0.05%, 0.5% on my bond. But now today I can get 1.6% on that bond. Again, that's 177% increase in bond yields. So hedge funds are like, great, I'm gonna get out of this whole risky thing, which is the stock market, and put some of that huge money, not all of it, but some of that huge money back into bonds where I can get 1.6, 1.7%. Because remember, on $10 billion, that's a lot of money. So the reason we've been seeing the market kind of going through these trials and tribulations is because when bond yields rise, so right now there's no competition for the stock market. At least there wasn't until the bond started rising. Stocks were all they had. Stocks were the only place you could really get yield, right? But now that bonds have jumped up to the mid 1%, 1.5, 1.6%. Big money is now like, look, I'll put some money over there because remember, that is guaranteed by the federal government. It's backed by the good faith of the federal government. They know they'll get their money back. Whereas you put in the stock market, $10 billion, you're risking things. So a lot of these big companies have been putting a lot of their money out of the market and now buying bonds, because again, bonds are relatively attractive to what they were a year ago. So the adage is, the thought process is that when interest rates rise, it's bad for the stock market, which in turn is bad for our portfolios. Because as I said, big companies pull money out of the market and put it into bonds, which then would depress stock prices, is the theory, right? And I subscribed to that theory up until I saw this research. So Brent pulled up the slide for slide 1, and this is going to show you that actually rising interest rates are actually really, really, really good for the stock market, which means we're currently in a rising interest rate environment, which means rates are going to continue to steadily rise. Maybe not the clip they've done the last month, but they're going to steadily rise because we're at zero now, and they can only go up from here. So we're going to show this is actually a really, really good time to be in the market. So the first bullet point on the slide is showing that it says that the S&P 500 has returned on average 14.2% during periods of rising interest rates versus just 6.4% on average during declining rates, right? So what does that mean? Now remember, think about it. The stock market on average over the last 100 years returns 10% per year. What this is showing is that in cases when interest rates are rising, the market actually returns 40% higher than its average, 14.2% versus 10%. Now remember, most people think that rising interest rates are bad for the market because the big boys are going to pull their money out and put it into bonds and depress prices. While part of that is true, because they do that, and it does add volatility. But actually in the long term, because remember, think about it. When rates are rising, well, let me just tell you, when rates are rising, the reason rates rise is because, so what happens is, let me take a step back and explain how bonds work. So bond rates are inverse to price. So as price of bond drops, the rate goes higher. And as the price of bond rises, the rate goes lower, right? So what's happening now is the economy is going to be improving coming out of COVID. Everything's looking good with the vaccine. So there are two fears by economists. One is that right now in savings accounts, the thing we say never put your money into, but everybody's been doing because we've been home, there's $4 trillion with a T, $4 trillion right now sitting in American savings accounts. That's one, right? That hasn't been deployed in the economy. Point two is that we have a $1.9 trillion COVID relief plan that's going to be approved by Congress in the next probably week or two, right? So that's right there is almost $5 trillion that's going to flood the economy and boost the economy. So what does that mean? That means that you're going to have rising inflation because you're going to have all these dollars, trillions of dollars chasing, everything from, cruise lines to airlines to food. It's going to be the whole supply and demand thing. So we're going to get rising inflation. Well, what that does for bonds, people that are in bonds say, well, look, if inflation is going up, right, the rate of return I'm getting on my bond right now is low, right? Because you're getting, say you're getting 0.5%. But remember, as everyone sells those bonds, the bond yield increases. So people are like, well, look, I'm going to sell my current low bond to buy the higher paying bond. And so what happens over time is that the return on the bond looks a lot better than the return on the old bond, which again is competition for the stock market. So everyone thinks that when bond yields rise, people, big money is going to pull out the stock market, the stock going to be depressed. That's true in the short term, but not in the long term. As we see here, on rising interest rate environments, the market returns on average 14.2%, rather than the user average of just 10%. That's the environment we're in right now. So right now is actually a really, really good time to put money into the markets. Second point shows and kind of reinforces that in 7 interest rate cycles since 1990, in which rates rose for a prolonged.
Yo, real quick. So some people might not know, like they've heard the term like bonds or treasuries or notes, and they're like, what's the difference? Like, what is a bond? And then they hear about, the 10-year bond, or is it a junk bond? Corporate bonds. Essentially, we're talking about the 10-year plus bond. And the reason why people switch it out is because normally bonds are longer yield products. And when people get locked into them and this new series of bonds come out, they have to, before maturity comes, liquidate their bonds to buy. In not all cases they have to liquidate, but in some cases they liquidate to buy new bonds. And the difference between that and treasuries, treasuries and bonds, really the same thing. They're indebtedness, but which means, you're basically letting somebody borrow your money. But treasuries normally are, I think, 5 years or less, or a year or less. And that's the biggest difference between the bonds and treasuries. And when Leon's talking about, he mentioned it briefly, and we're not going to talk too much about it, but I think it's important to note the 10-year bond follows or directly impacts mortgage notes. And so when you can follow what's happening with the 10-year bond, you pretty much know what's happening with mortgage interest rates. That's really important if you're, we talk about demystifying the stock market and other investments. For you other investment people who are into the real estate game, you should have an intimate understanding of the 10-year bond. Really important. It will really just up your IQ as it stands to, as it relates to understanding the market and how real estate works, or, real estate interest rates work. But just wanted to kind of point those things out because some people wonder what it is. And also I said about the corporate bonds. Corporate bonds are not the same thing as a 10-year bond. And when I talked about junk bonds are also sometimes no different than just corporate bonds, in which case investors who are looking for something that gives them a little bit more stability, but higher interest rates when we're in a low interest rate marketplace, go to corporate bonds very often, because corporate bonds or junk bonds tend to have a higher yield on them, because you're actually lending your money to a corporation, and the corporation says, thank you for lending it to us. We'll give you a higher interest rate than what you would normally get at the bank. So also one of the things that happens in, when we get to higher bond, 10-year bond notes seasons, they pull their money also out of corporate bonds sometimes. So you can see companies pulling their money out of corporate bonds to get a more secure bond, which would be the 10-year. So just FYI.
Yeah, the 10-year bond, like corporate bonds, are backed by the company, which a company can fail, right? So if you you buy a bond, you lend your money to a corporation. If that company fails, you may not get your money back. Whereas with the 10-year treasury bond, you're going to get your money back because it's backed by the U.S. government. So that's kind of a distinction between the two. But so second point basically reinforces the first point, right? That rising interest rate environments are actually really, really good for the stock market long term. So right now the stock market is going haywire right now because it doesn't really know what to do with this. Like, we're about to get, there's $4 trillion sitting in people's savings account. We're about to get another $1.9 trillion from stimulus. That's $5 trillion that's going to flood the economy in the second half of this year into next year. That's going to bring tons of inflation, which is then going to depress bond prices, which is going to push yields up. And people think, again, bonds are now competitive to the stock market, so big money is going to pull their money out of the stock market and put it into bonds. That's the theory, right? That's going to depress the stock market. Well, again, the data shows that actually is not the case. In rising rate environments like we're in right now, the stock market actually returns 40% higher than it typically does. It typically returns 10%, and on average returns 14% in rising rate environments. And in periods of prolonged rising rates, it actually returned 15% over that same 31-year period. So last point is that rising rates are generally a good thing generally a good thing in general, because it signals an improving economy. So when you hear about, rising rates is bad for the economy or bad for the stock market, this data here shows you that actually that's not true. The rising rates are actually good for the economy, because that says the economy is getting better. Which, if the economy is getting better, that's going to impact companies' profits. The companies that we own, their profits and their stocks are eventually going to rise. So, go ahead.
For this last point, we have a colleague that we talk to all the time, Attorney Beverly Winstead, and she once made a statement when we were talking that the government basically uses like tax law and other laws to control behavior of people. And, inflation is no different. When the government wants you to spend money, they tighten up. When they think, okay, you should hold your money, then they loosen up. So in these places, the government really does put rising inflation in place to allow us, or to say, you know what, we know you're not spending money, so let us lower rates so you continue to buy houses, so you buy cars, so you buy the big ticket items, because we want you to keep spending money. So we're going to offset it with lower rates. And then when they say, okay, it looks like everybody's doing well, that's when you see the rates come up again. Like Leon said, it's a kind of signal that the government sees light at the end of the tunnel. So just It's something to understand that it is a behavioral mechanism used to control behavior for consumers.
Yeah, I mean, the fact the Fed, once the Fed, right now the Fed is keeping rates artificially low because they basically want money to be free, so that we all go out here and borrow money and buy things to pump the economy. And they said that they're going to let inflation, as we all know right now, there is inflation, right? We all see it with everything that we're buying, from food to household products. We see inflation is here, but with the Fed tracks, they're saying there's no inflation, but they're saying once inflation hits about 2.5%, they're then going to start raising rates, and they said they won't start doing that till at least 2023, 2024. So what they call it, they're going to let the economy, quote unquote, run hot over the next 2 to 3 years. So that's great news for us as investors, because that means money is going to remain relatively free at these really, really low interest rates, which means big business can borrow money at almost nothing to invest in equipment, invest in people, invest in buildings, which is going to keep the economy going. So, so you want to make this point. Oh, go ahead.
No, I was just going to say, when looking at that, essentially it makes money affordable. I know that sounds like a crazy thing to say. Like, what do you mean when you say make money affordable? Often, especially in the Black community, we're not able to borrow money because the terms to pay it back are exorbitant. And, for corporations too, although it's a different scenario, it just doesn't look good on their books when they're borrowing expensive money. We're in an environment right now where money is relatively affordable. So if you're looking at a house, the interest rate, like I own this office, and me and my partner, we decided to actually, I rent my office from my wife, but my wife owns this office. And, we just did a 15-year switch from a 30 to a 15 because interest rates were low. And the 15-year mortgage now on this is actually cheaper than what our 30-year was. And, these things, we took advantage of the environment to, get an affordable loan, because money's affordable right now. So just think about, if you have the next 2-3 years, what is your strategy to take advantage of this marketplace? What is your strategy to make sure that when this is done, you're like, you know what, I made some good investments during that time period? Because when interest rates start to rise again, money becomes less affordable to some people. And it really depends on what you do and how you kind of arrange your mindset today about what you're going to do with your money.
Yep. And so the key takeaway from this whole thing, I mean, I know this subject is a little dry, a little wonky, but it's really, really important. The key takeaway from this is that we're currently in a rising rate environment. The 10-year Treasury is up 177% in about 8 to 8 months. It hit 1.6 2 days ago. The market lost its mind. Today the market was down 1.2%. This is going to bring volatility, because again, these big companies are going to take some money out of the market and go buy bonds at 1.6%. Because again, if you have $10 billion, 1.6% on $10 billion is a lot of money, right? And there's no risk in that because it's backed by the federal government. So this is going to cause volatility. However, rising rates also means that the economy is improving, and that investors see the future growth of the economy being good. And that's typically what happens. So this is actually a really, really good time to get in the market. Yes, there's going to be volatility, but as I said, the market in this type of environment returns 14% versus on average 10%, over the last 100 years or so. So just want everybody to know that, again, dry subject, but very important subjects at the same time.
Yep. And as always, we owe you all some picks. So we're going to give you the picks. But before we do that, I wanted to say, if you're interested in joining IEA, you can go to IEAmembers.com. We're happy to have new members. We are steady growing. You can also look us up on Facebook. Go to Investing Education Academy on Facebook. Just run a search for Investing Education Academy. We will pop up. We just broke 400 members. So that's pretty awesome, because I remember when it was 6 of us. And that was just last year. So within a year.
And 2 of those were me and you.
Yeah, right. So yeah, that's crazy. But we're 400 plus members. We're growing. Last year we had members telling us they closed out the year at 12%, 40%, 10%. Some people, had upwards of 70%. It's a great thing. Like, we're happy, but that's not always the story of the market, right? It's not always this beautiful thing that just stays at positive territory. And as much as we talk to all of our investors or our members about, understand that the market can get you a higher rate of return, even if you have a year where you're maybe negative because you were overly aggressive, or you just maybe had some picks that weren't the best picks in the world. The market by and large is still one of the best places to to gain wealth in America. And if you're out there and you're like, I didn't close out the year that great, give it time, because time is the great equalizer in the stock market. And if anybody has been in Leon and I's ecosystem in the last year, we have said 10,000 plus times, next year will not be like 2020. We said it. We've said it continuously. We're going to continue with that mantra. That was an anomaly. The market doesn't grow like that all the time. So if you came into the market in 2020 and you thought, oh, this is how it's always going to be, it is not. But it is normally far better than being in a savings account or any type bank equivalent investment. And I say that to say, because I got a phone call personally from somebody who was like, what's going on with the market? I was like, oh, well, what's happening with your portfolio? And his statement to me was, and then please listen to this, I'm only at 52% rate of return. Something must be wrong. I said, are you really calling me for a 52% rate of return? And he was like, I'm just not used to it being that low. So the market is beautiful, but please don't get these golden glasses and start thinking everything's just money falling out the sky. It's not. Just be committed to the process. Give yourself time. Become part of communities like Investing Education Academy. Surround yourself with people who this is normal conversation. Because still, as much as it seems like it is, for the large part of America, talking about investing, the stock market, real estate, entrepreneurship is not a normal conversation. So we welcome you to Investing Education Academy if you'd like to join. And also you can find us on Clubhouse after this is over, just kind of talking about all things money. So with that being said, I'll go first with the pick, Leon.
All right.
So I picked something household name, stable, Johnson & Johnson. Everybody knows Johnson & Johnson. They make all the household products that we collect in our closets and inherited from parents and all kind of other things used for our children. They are a company, we're talking about $410 billion market cap. They are not going anywhere. The reason I picked Johnson & Johnson is I've been going very heavy in tech and EV, solar, and everything really in the tech space since we started, truthfully. And I just wanted to get some dividend plays into this. So Johnson & Johnson pays a 4% dividend, which is amazing, especially when you talk about the average. I don't even like saying it out loud, but the average savings account in the United States of America is paying 0.05%. Getting into an investment that's stable, that is paying 4% dividend, helps you fight against inflation and also continue growing your money while adding to the appreciation that the stock may experience while you own it. So the ticker symbol is JNJ. It's currently trading at $156 per share. This will not be a fast grower, everybody. This will not be the one that knocks it out of the park, nor is it intended to. We want to have a mix of investments inside your portfolio that give you, exposure to different sectors, and also they grow at different rates. So Johnson Johnson, slow grower, great dividend. That's the reason I chose it today.
Yep. And I just want to say real quick. So just to reiterate, I can't believe somebody called you complaining about 52%. So just to reiterate, the stock market on average returns 10% per year. If you're making 11% per year, you're great. If you're making 52%, you're absolutely killing it. And like Brett said, last year was an anomaly. We had a once in a 100, 200 year pandemic hit the world. So yeah, just have perspective, 10% per year. If you're making more than that for the stock market, you're doing great. So my pick is AMD, Advanced Micro Devices. Ticker symbol is AMD. And the reason I picked them is because I am absolutely giddy right now with the way the market is looking. AMD is down big. The market is down big, but I have a good 20 stocks I'm eyeing keenly every day. AMD be one of them, Nvidia being one of them. I have a lot of companies I'm looking at, and AMD is definitely on my target. I started buying it at around 84, 86, and I've been dollar cost averaging my way down. Now that it's at 80, I just can't wait till tomorrow to buy some more. So I'm just dollar cost averaging my way down in AMD. And remember, I always said this, people that have been following us, the number one sector is solar. Number two sector is technology, but within technology, the number one sector is semiconductors and AMD, or chip companies. And AMD is in that sector, in one of the top sectors in the industry. So that's why I'm really looking hard right now at semiconductor companies that have been beaten down, like AMD, like Intel, like Nvidia, like Broadcom. So my pick is AMD. Quick stats. They control. So if anybody remembers back in the 90s, Intel controlled everything, right? They controlled desktops and laptops. Well, AMD now controls 81% of microprocessors on desktops, whereas Intel controls 81% microprocessors on laptops. So AMD went from nothing in the 90s to now controlling over 80% of the desktop market, and is chipping away at Intel's laptop market. Their financials, so they're growing their revenues on average 24% over the last 3 years, and they're growing their profits on average 197% over the last 3 years. So massive growth in one of the top spaces that you can be in right now, which is semiconductors inside technology. So AMD, ticker symbol AMD, is my pick.
All right. So if you all would like to join us over on Clubhouse, look for Leon Noble or Brent Simpson. We'll be happy to expand on this conversation. And we thank you all for listening, your viewership. We're already over like 5,000 views, and it's just March. So thank you. And we will see you next Wednesday, 9 p.m. for more information. Have a good day.